And as of Monday, new federal rules have taken effect, allowing smaller investors to get in on the startup action. Companies can now raise up to $1 million without prior approval from the Securities and Exchange Commission. For more on this, I'm joined by Jason Best. He is the co-founder and principal of Crowdfund Capital Advisors. Jason, thanks for joining us.
Thanks for having me.
So Jason, new crowdfunding rules mean you no longer have to have a net worth of over $1 million to get into the startup game, and Americans who make $100,000 can invest $2,000 or no more than 5% of their income into new ventures. So what has brought on this big change?
Well, we really began talking about this back at the end of 2010, and it was time to modernize the securities laws here in the United States to allow more people to be able to participate in these markets. The laws around who could invest in private companies and startups had not changed in 80 years. And so really having laws that were written back before most people had a landline telephone in their house didn't seem to make sense to us anymore in the age of Facebook and Twitter. And so this is an opportunity for small businesses and startups, for the first time in American history, to go out and raise capital from their communities and their customers.
It's an opportunity for small businesses, also potentially a big opportunity for small investors. But even though there is a funding cap, there is a big concern that people will prey on mom and pop or rookie investors. What are the risks here for investors?
Well, I think that any investment into a small business or a startup is high risk. And so investors need to take common sense measures and utilize the technology that's available to help protect them. Certainly one of the things we worked on today at the celebration and demo day was to be 7 technologies that are out there today to provide ways for people to make investments, but also a great deal of it was around transparency and trust, around data and analytics that's available, money transfer, and other innovations that are being created to help, including education services, to help investors really understand what they're doing. We certainly recommend that investors really pay close attention to what they're investing in, but that it can be something that they can help to lower their own risks through utilizing the technology that's now available.
So Jason, let's say investors do their due diligence, they've done their homework. After the investment, what proof of equity do these investors get?
They have shares of stock. They have shares just like they would if they were buying shares of Apple or Microsoft. And those are kept on electronic share registries in most cases by the crowdfunding platforms, and they can access those whenever they'd like.
But when you buy a regular stock, you get an earnings report that needs to conform to certain established standards. What level of disclosure and information are these companies obligated to disclose, and how frequently are we talking about? Quarterly reports? What is the standard?
So that's a great question. Obviously, to begin the raise, these companies need to file what's called Form C, which allows them to provide a full set of disclosure on their finances and other material information, so there can be fulsome disclosure. There are services out there that provide this in a standardized way. One example is iDisclose, that allows business owners to be able to do this in a very cost-effective and time-efficient manner. Then companies are required to do annual filings by law of their financials and their other statements that you would expect to see. But certainly we believe that it's in the business's best interest to provide more regular and fulsome disclosure on a quarterly basis to allow them to be able to communicate effectively with their shareholders and their community.
Right, and that would, of course, increase investor confidence. Now, companies are capped at raising $1 million per year through this. Jason, what type of businesses or ventures are most likely to now benefit from this?
Well, there are 3 forms of crowdfunding that are now available through the Jobs Act. The first is for accredited investors. The second, which allows people to raise up to from $20 to $50 million from both accredited investors and unaccredited investors. And then third, what we're talking about here today, for unaccredited investors raising up to $1 million. I think the 2 great use cases for this: one, Main Street businesses, companies that have customers and profits, and community-based businesses like a construction business that's looking to add a second location, or a restaurant that wants to expand delivery hours. Companies that need working capital, that have profits and can support these things, are really beneficial. We believe they may use debt-based crowdfunding. The other great use case for this are startups. Technology startups or other kinds of startups that are just getting going, need that first little bit of capital to test their product, test their market, and this is a great way for them to raise that starter capital. What it allows is, for the first time, businesses that are not located in Silicon Valley or in New York or in Boston to get access to early stage capital, which can help them to get off the ground, and then to raise their visibility to be able to find additional follow-on capital if they're successful.
All right, we're going to have to leave it there. Thank you so much, Jason Best, co-founder and principal of Crowdfund Capital Advisors.
If you like what you just saw, follow us on social media and visit our website, CCTV-America.com.